Welcome back. It's time to say hello to our next guest on the show. We have Nikhil Ranka, CIO Equity Alternatives at Nuvama Asset Management, joining in. Nikhil, good to have you on the show. Welcome to Closing Bell. So we were just going through the kind of funds that you manage. I think the two strategies that you look at, it's a mix of long, short, and I think you also look at some technical indicators and positions, and of course, fundamentals as well. So just tell us, what's the market call as you see things right now?
So good afternoon, Surabhi and Nigel, and thanks for having me on the show. So as you said, we have our flagship fund Edge, which is a long short fund, and we also have our absolute return strategy. Now coming to the market outlook, if you look at the longer term valuations at where markets have traded, broadly the median multiple is closer to 19.5 times 1 year forward earnings. Today, as we stand, if you look at the Nifty EPS, consensus Nifty EPS for FY25, we are somewhere closer to 1130. And for FY26, we are closer to 1260 rupees of earnings estimate. Now, if I put a 20 times multiple to that 1260 rupees of EPS, then we get a fair value of Nifty closer to 25,200, which is not very far away from here on. And typically what we have seen is we get a multiple re-rating cycle when we see earnings upgrade. If you see the Q1 earnings that we just finished for FY25, on an ex-OMC basis, we have seen high single-digit growth on Nifty earnings. And if you take OMCs as well, we are sub 5% in terms of earnings growth for this quarter. So my sense is the base case is that we will have some sort of time consolidation in the near term. However, 6-9 months down the line, when we roll over to FY27 earnings, we will probably be looking at closer to 1400 rupees of EPS for FY27. And then using the same valuation framework of 20 times, we could then be staring at a Nifty target of closer to 28,000. So if we get a decent dip of 4-5% on the markets, then one should look to add back positions in markets.
All right. Hi, Nikhil. Good afternoon and good to have you on the show. Nikhil, the markets today are reminding you of Mike Tyson in its prime, right? You throw it anything and it's punching it out. Whether you talk about a war, you talk about weak data, you talk about good data, you throw anything at it and it's knocking it back out. So we've got the upside targets. Near term, 25,200. Maybe in the longer term, we head towards 28,000 odd. What's the downside risk, though? What's the, you said maybe you could, look to add if you get a 4-5% correction. But at the extreme end, what should the downside look like? That's the worry, right? So I wanted to ask you your view.
Correct. So typically, Nigel, negatives which are known to the markets will not lead to a major fall in markets. So be it the Middle East crisis, we've seen crude flaring up because of that, but this is something which is well known to the markets. If there's some sort of political instability that comes through, if we see BJP losing their grip in the state elections, then that's some sort of worry, because markets will then start building that there could be some populism that can come through, and that could lead to a 4-5% correction in the markets. But if you look at the cash levels with mutual funds and the liquidity that is flashing around, I think unless there is something which markets cannot see today, it is unlikely that we will have more than a 4-5% correction in the markets. And if we get to that 4-5% correction mark, we get to 24,000 levels, then as I said, from a 12 to 15 month horizon, you are looking at a levels closer to 28,000, which would mean that you will still make 15-17% in the markets. And my sense is everybody will start to get their dry powder deployed if we get that 4-5% dip in the markets.
Nikhil, let's go with the key overweights on the long side. What are the major positions that you have, and what do you like at the moment?
So in terms of overweight, if you look at it, banking and OMCs are the two sectors that we are positive on. So firstly, if you look at banking, some of the large cap banking names, if you look at it 2-3 years back, they were trading at closer to 3-3.5 times 1 year forward price to book. Today, if you look at that sector, valuations have compressed to probably 1.8 to 2 times FY26 price to book. And these are still making 15% ROE profile. So the base case is that even if multiples do not re-rate from here, you will at least compound at the book value, and therefore if 15% is what the book will compound at, one can look to make at least 15% from the large cap banking names. If you look at some of the larger PSU names on the banking side and you strip off the value of subsidiaries at closer to 240 rupees and you take standalone book FY26 book at close to 560 rupees, then probably it becomes more closer to one-time price to book for a 15% ROE profile. And we feel from here on the downside will be very limited in those names. The street is obviously concerned about the NIM compression that will come through once we have the rate cut cycle coming up, because if you look for most of the banks, almost 40% of the book is linked to repo rates. So when the first rate cut happens, banks will have to pass on the lending rate cut immediately. But given the challenges on deposit mobilization, the fall in deposit rates will happen with a lag. So you could have 4 or 5 bips of NIM compression that can come through. And we've also seen some sort of credit cost inching up on the retail side. Having said that, my sense is valuations are factoring most of the negatives for banking names. And these are good levels to enter into banking with a medium-term horizon. Second, if you look at OMCs, you have two components of earnings for OMCs. One is on the refining side and one is on the marketing side. Refining, undoubtedly, we've seen some cool off. Indian refining margins have come closer to $5.5, $6 per barrel. But if you look at, 2-3 days back, the marketing margins on petrol, they were closer to 8 rupees. On diesel, they were closer to 7 rupees. And our view is, notwithstanding the near-term volatility in crude prices, if you look at the spare capacity that is available with OPEC is today at a production of close to 27 million barrels, and they have close to 6.5 million barrels as the spare capacity which they can raise output if there is some supply disruption that happens in the near term. Iran total production is close to 3.3 million barrels. So even if there is some sort of geopolitical tension that spikes up, my sense is the up move in crude oil prices will be pretty short-lived. And those corrections can actually give very good entry points for some of the OMC's names.
Okay, all right. Nikhil, all that glitters is not steel. I believe that's the mantra. We have been talking about how these metal stocks are doing well. You wouldn't be allocating out there. But what if someone has it? Will you be advising them that maybe gradually book out some of these positions on these bounces?
So Nigel, we have a cautious view on steel actually. So 2-3 factors for our cautious view. Firstly, if you look at our FY24 consumption of steel, we were closer to 135 million tons. Now, in the next 6-8 months, as a whole, the industry is likely to add closer to 25 million tons of steel capacity. All the major guys are adding 4-5 million tons individually, be it JSW Steel, Arcelor, Tata's Kalinganagar project, even NMDC Steel will ramp up to its full 3 million ton capacity. And we've seen historically that demand growth has been in the high single-digit number. So once all this capacity comes up, it's likely to put some pressure on the utilization rates for most of the large guys. Secondly, if you look at the pricing dynamics, today the domestic prices are at a 4,000 rupees premium to what the importer parity pricing works to. So even if there is some sort of uptick in the international steel markets, my sense is our prices will move up with a lag. The third point is, if you look at the recent Supreme Court ruling, they have allowed states to levy taxes retrospectively on the minerals. And therefore, you will see that, whenever states are short on some sort of budget, they can increase the royalty on minerals, and that will create another headwind. And finally, if you look at it post 2020, some of the captive mines which were allocated to large cap steel guys, there they will come up for rebidding. You will have to bid at some sort of royalty to the Indian Bureau of Mine Prices. So a combination of all these factors makes us feel that probably profitability will get capped for steel names, and they are still trading at closer to 7 times FY26 EV EBITDA. So the risks on the steel seem to be more on the downside for us rather than on the upside. So we are underweight on that sector.
Okay, underweight on steel. So just to round that off, are you running shorts? I mean, is that one sector where your maximum shorts would be? We discussed the long. So on the short side, is it metal? Is it something else? Just very quickly, just the sector, so we know the strategy and the portfolio mix.
So broadly, I would say our major hedges are through indices, should be so because that's more representative of the overall portfolio that we run. So there can be some short position here or there, but broadly, I would say whatever exposures that we have to manage in terms of our net deltas, that we typically do through indices, Nifty and Bank.
Okay. Got it, got it. So the shorts and the hedging there managed more through the indices than rather stocks or sectors. Got it. Thank you very much, Nikhil. Good to have you on the show today. Appreciate you taking out the time and being with us. Thank you for watching CNBC TV 18 and do follow us on all our social media platforms for news, updates and more.